Stocks our strategists feel are poised to deliver positive returns are featured now in their top stock picks of the week.
Hi, David Boren here with Zacks Investment Research, and I'll be joined by Shiraz Mian for today's top stock picks of the week. My top stock pick today is Scott's Miracle-Gro. This is a fairly household name. I'm sure you've heard of them. They sell the turf builder products. They sell Scott's fertilizer and seed and the other namesake product, Miracle-Gro. They also have a set of commercial products, including Liquifeed and Osmocote, products that contractors use for larger projects. This seems like a discretionary item in terms of sector, but it's really turning out to be closer to a staple as people really can't let their lawns and the like go. So these products continue to sell. They're also sold in big box stores and home improvement stores that remain open during the crisis. So unlike a lot of products that are sold at retail, consumers don't have a problem getting their hands on the Scotts products. Now, Scotts also owns the Hawthorne division. This is something that they put together by themselves, but then also have been making strategic acquisitions, and this caters to the marijuana or cannabis cultivation markets. Now, they have products both for commercial grows, chemicals and the like, and then also products for home hobby growers with hydroponics and lighting systems. Now, Hawthorne made up 21% of Scotts sales last year. It was a big surprise. It's a very fast-growing sector. It makes Scotts one of these pot stocks, but it's been about the best performing pot stock of the last year because they still have this really solid consumer business in their core business, and then they add the marijuana business on top. Now, during lockdown, we're actually seeing a big increase in retail sales of marijuana in the places that it's legal, and then also an increase in the amount of home cultivators. So people are trying to grow this at home. They have the time on their hands. They have a desire for the product. It just kind of makes sense. Now, Scotts is going to report earnings this Wednesday. This is typically a good quarter for them seasonally. As you'd imagine, the quarters that include the spring and the summer planting and growing seasons are the best for them. So next quarter is typically a good one too. We're going to be looking for $4.04 of earnings on $1.4 billion in revenue. Now, a real positive thing for Scotts here is that there's a real tight range in high and low estimates. For a lot of companies right now, we're seeing the spread between the estimates grow because analysts really are just guessing. Right? Companies are pulling guidance. They're not really sure what's going to happen. But for Scotts, the estimates really remain in a very tight range. So for the full year, we're looking for $3.4 billion in revenues. That's up 7% over last year. And then for next year, it's a little higher, $3.5 billion, so up another little over 3%. Now, those numbers in normal times don't sound very exciting, right? 7 and 3% sales growth. But in this environment where earnings estimates and revenue estimates are being slashed all over the place, that's actually pretty comforting and exciting. Suddenly, mid-single-digit growth starts to look pretty good. Now, the Scotts shares got beat down with the rest of the market in March, and in that March 23rd low, they hit $78 a share. Now, they've almost fully recovered those losses, and they're up nearly 20% on the year. Now, that's compared to a S&P and a Dow that are still down 13 and 17% respectively. Now, that also means that Scotts stock is not cheap. It's trading at a forward PE of 24. But that's actually a good sign in this market, right? Forward PEs, and we've been talking about this lately around the Zacks editor desk, forward PEs are certainly becoming less reliable than they used to be simply because those estimates are growing so much. The range of estimates is growing so much. They're getting so wide. So with Scotts to have a 24, but with those tight estimates means the market has a lot of confidence in it. Now, last thing is they also pay a 2% dividend yield. Just like the revenue growth, this is a number that used to sound really boring, right? 2% when there's a lot of stocks out there paying 4, 5, 7%, except all those big dividends are in jeopardy. A lot of companies are reducing or suspending dividends right now, and the Scotts dividend is really safe. So again, it's not spectacular, but you're going to get your 2%. So with solid overall sales that are unlikely to be significantly affected by our current situation and the possibility of a really positive surprise out of the Hawthorne division, I think Scotts is a great top stock pick of the week. Now I'm going to send it over to Shiraz.
Hi, thanks, David. My top pick is this government contractor called Casey International, ticker CACI, about $6.5 billion market cap. This is a stock that is currently essentially flat on the year. It went down with the rest of the market, but through the March 23rd bottom has recouped practically all of those losses. And the primary reason for the stock's outperformance relative to the market, as we know, is down close to 10% now for the year, is this primary customer being the U.S. federal government and state governments. About 2/3 of revenue comes from the Department of Defense. There is the Health and Human Services, a couple of other civilian federal government agencies, and then state governments. The one thing that I feel very strongly about in these otherwise very uncertain and hard to forecast times is the outlook for federal budget. And the big risk for Casey is budget cuts at the federal level. The odds of that happening, in my judgment, are extremely low. And that's the reason why I like Casey. For the current environment, we have held the stock in the focus list portfolio since late 2015. Has been a strong performer for us. But I strongly feel that even though it has had impressive gains this year, I see the multiple expanding on the back of continued momentum in contract wins and relatively low risk to business, irrespective of the shape of the eventual recovery, whether it's a V, whether it's a U, whether it's an L, all the different letter shapes that everybody's talking about when discussing the recovery. So some brief details about Casey. As I mentioned, about $6.5 billion market cap. They reported last week the market wasn't particularly happy with the results, but in my judgment, that was more a question of the very strong momentum we had seen in the stock ahead of the release. The backlog is now close to $20 billion, which, even though it's a tad bit below what was the case by March end 2019, there have been a number of 400+ million contract wins from the federal government through April and the period since, which makes me think that the backlog and momentum on the revenue front should continue in 2020 and beyond. One other factor to keep in mind while considering Casey is that it is not just your run-of-the-mill IT consulting firm. It's more on the cybersecurity side, and the need for and the demand for that expertise will only increase as we go further along. Valuation is reasonable relative to its peers that rely primarily on the private sector. It trades at a discount. It does not pay a dividend. Revenue growth over the next 2-3 years, in my judgment, should be in the high single digits, low double digits range. Management has chalked out a fairly reasonable pathway for further margin expansion that gives the opportunity for additional incremental bottom line and cash flow gains. Balance sheet is in good shape. They have a fairly large, unutilized revolving credit facility, and overall balance sheet leverage remains reasonable. All in all, a relatively attractive and relatively under the radar mid-cap name that has a lower risk profile and exposure in these uncertain times, and stands to benefit from the steady growth in federal government spending, which we all see on the horizon for this year and beyond.